welcome. You're watching India Market Open, and we've come back to work after what a Thursday afternoon.
Yeah, I love the music.
Yeah, it goes with the trend, with the feeling.
Yeah, it so does. But what a move yesterday, Samina. It was quite stunning, really. I missed you anchoring yesterday because it was a solid day of trade.
Yeah, I saw that, and it was almost feeling of missing out almost, right? Because the move was stupendous. It came in such a short period of time and rather unexpected. There was no data, no trend indicating of such a big up move in trade. We made a new record high intraday as well.
Yeah, except for, I'm putting two and two together. I don't know if the China mortgage cut news story that came out on Bloomberg really triggered it. It came in a month ago as well, but it came in around 1:30 p.m. So I'm just correlating two and two together and trying to see if that happened. But yeah, be that as it may, great news from that perspective. And some comments that are coming in from the Reserve Bank of India, Samina, today, before we get to the global piece, because the RBI governor in that conversation has laid out some pretty interesting statements about growth and the growth possibilities and about a whole host of other things which are also very, very interesting.
And a controlled inflation, even though there's a slight uptick. But I think the other thing that some people have said could have contributed to the up move yesterday was the release of liquidity that was blocked for the Bajaj Housing Finance IPO. So it was about 3 lakh crore rupees that came back into the system yesterday. So there was some desk that believed that because of that liquidity, there could be a little bit of aid coming into our markets. But who's to tell? There is no way fighting the trend. Yeah,
there is just one thing that you can very definitely say, that it was the FI buying which caused this, right? I mean, even if you discount for the Honasa block of 1,700 crores, 7,600 crores. This is pure secondary market buying. The FI flows, probably the largest that we've seen in a really long time, and it really helped the market.
I think they're lapping it up before the rate cut. Of course, there are reports that it takes a while for a rate cut to impact emerging market flows in a positive way. But talking about rate cuts, it was also the European Central Bank that cut rates. No surprises there. The Street was anticipating it. 0.25% rate cut was given by the ECB. This is the second rate cut that the ECB has conducted this year. They want committal about the future course of rate cuts, but nevertheless, European markets look good. That's when the markets opened up in Europe, and our markets as well reacted at that similar sort of time when new record highs were made. But a quick check of what's happening all over the world, it's a good-looking picture, at least for most markets, ex-China and maybe Japan taking some profits off the table. Well, a quick fact that I just discovered, Chinese markets are trading at their lowest level since 2019. Now, that cannot be good news for any of those markets. It made that intraday blip at that level, retested it, and of course, it started moving up just about slightly for those Chinese markets. Apart from that, Japan is seeing some profit taking. Yesterday was a pretty solid day for those markets as well. So, those markets now taking a breather as we see it. All eyes, or rather all cues, came from Wall Street. It was a firm session, 4th straight days of gains coming in for U.S. equities. The Dow, the Nasdaq, and the S&P 500 all eked out very smart gains, with the Dow gaining 235 points. Well, there was inflation data coming in from Wall Street as well, or the U.S. economy in that sense, which indicated that the producer price index, which is a parameter or a gauge for measuring inflation, came in at 0.2% in August versus an expectation of 0.1%, largely in line with what the street was expecting. You also had employment, so some data coming in on unemployment benefits that have risen 2,000 to seasonally adjusted 230,000 for the week ended September 7th. Again, in line with expectations, but this comes in for a week when there was a holiday in the US. So that data point, rather volatile, but largely indicating that there's no major hard landing or concerns for the US economy. 80 to 90% of the bets still remain on a 25 basis point rate cut, and that's going to be largely the only trigger that's going to be driving global equity markets over the next couple of days of trade. Apart from that, gold stocks, look at those gold miners on Wall Street, did really well. Across Australia as well this morning, gold miners are picking up interest. This is because gold prices made a new record high after they spent the last few days consolidating. Well, apart from that, a quick mention on crude. it did record lows early this week, but quite a smart rebound. So low-level buying was seen. Remember, there were concerns about slowing demand, China cutting back on its demand. More importantly, there was some talk about OPEC and supply. But of course, it seems like output disruption came to the rescue of the bulls for crude. Crude continued to add about 2% in gains overnight. So that's largely the way we have it. Silver's also been on a good run. Silver and gold usually work in tandem. Silver adding about 2.5% and platinum also closing in with a gain of 2%. So all in all, it's risk on. And I think the markets will continue to be choppy, volatile for the next few days till we go into that rate cut. And then it's uncharted territories in some
maybe
ways.
Global markets choppy. We are not looking at any choppiness.
We are not choppy. We've warned Niraj the last few days, but of course yesterday's. And I think maybe the ECB could be attributed to it as well, right?
Because preempting you had the ECB move,
ECB happened, our markets opened up, of course, continued trading, and that big gain really came in the last 2 hours of trade.
Let's ask Anurag Singh. He's managing partner at Ansid Capital, joins us right now on the show with his thoughts. Anurag, good having you. Thanks so much for joining in. Good morning from us here to you. This concerted buying in markets across the world yesterday, particularly India, but the rest of the world too, was left us thinking about what the possible reasons could be. Because after a long time, we also saw foreign flows coming into India in a big way. Was it this talk about China looking to cut mortgage rates, or is the market preempting a rate easing cycle from global central banks?
Yeah. Niraj, good morning. I think we are talking for the first time on the channel, so good having, thanks for having me here.
Pleasure is ours.
Niraj, look, I think it's, the runway is pretty clear, right? And, we all, the rates peaked out pretty much last June sometime, right? And after that, the conjecture has been how many rate cuts we'll get in 2024. Eventually, I think we'll get probably 3, so 25 basis point in every meeting. And that's a good enough start. I mean, just look at it in this context, that ultimately when they were raising from 0 to 5.5, then we needed a 50 basis point and a 75 basis point. But now, once they are kind of going back to something like a 3.5 by 2026, all we have is like 8 rate cuts. So my sense is there is no 50. I don't know why the market plugs in 50 sometimes. There's no crisis on that front. But I think that's a good start. And if the rates eventually, 10-year yield is already indicating 3.6, 3.7, and market really has eased out a bit in that sense. So I think, there is no, the economy is doing solid. The proverbial soft landing has been achieved. And Fed has pretty much done the impossible, right? So in that sense, I think US markets look very solid and very robust, at least for the next 2-3 years. There is no risk to the economy as such. So I think the estimates vary, but you take an estimate of about $250-$240 for S&P this year. And then, S&P is a fairly valued number at 5,600. Next year estimates are 6,000 to 65,000, right? So 6,500. So that's where we are, right? I think so. There's no kinds of concern from the US economy perspective. Let me just quickly touch upon the FI number, Niraj. There's a bit of opaqueness around who actually buys this. But my sense is, that the funds like BlackRock, for example, they saw outflow of about 1.5 billion again in August, right? Because of which, if the ETF see an outflow, then eventually every emerging market sells. So there is a bit of a, concern still, despite Indian valuations. If the ETFs continue to see outflow, then I think emerging markets will continue to see outflow, regardless of how the Indian market is doing. Niraj.
Anurag, hi. It's also Samina joining in. It's rather interesting how swiftly we go from concerns of a hard landing, worries about a recession, to a healthy economy. I mean, it literally takes 24 to 48 hours for the street to change its mind. We all do agree that equity markets preempt what the economy is going to do, and I think there's no fair way of saying whether the economy in the US is healthy just yet. But what we do know is that if a rate cut does come in, emerging markets become a preferred bet. And we've also seen historically the RBI follows on with the rate cut after the Fed to keep the rate differential in place. In that case, do you prefer equities or debt in India?
So, Samina, I would take equities any day in a falling rate environment. Now, I understand usually we recommend a 70-30, 30 being a debt, and 70 being equity. Equities benefit with a rate cut, and bonds, of course. I mean, look at if the rates in US, even in India, for example, if the 10-year yield kind of eventually drops to 6%, there is a good return to be had in bonds for the next couple of years, right? US, there is a bit more return to be had because the cut is relatively going to be higher from 5.5 to 3.5. So that's good, but it depends on your style. Ultimately, I don't think in India, no matter how much we talk about it, anybody is going to listen to us if we tell or recommend invest in bonds, because that's not the environment right now in India. In US, 70-30 works pretty fine. If not 60-40, 70-30 works very well. My style personally, and a lot of people, we love it when the rate cut happens. US markets, I think we must, you would know this as well. It's very highly skewed, right? So about 35% of the market cap contributed by 6-7 stocks. I think the rest of the market is really at a very mouth-watering valuation. So look at Russell, look at S&P 600. So, look at financials, healthcare. These are the sectors that do well when the rate cut happens, right? So I think that's a very good position to be in. There's a bit of a broadening of the market that's happening out here in US. India is a very different story. That'll have to be seen very differently. Quick comment on the RBI piece, Samina. I think, so one is this, the CPI in India, the index, I think just a quick thought, and I'm sure the wise people know this better. The CPI needs a bit of a rejig. I think the 50% of CPI is food inflation in India. So I don't know whether RBI rate cuts impact or doesn't impact the inflation number as such. So that's a bit of a long-term project that India has on its hands. Other than that, I think, RBI can cut. I think across the world, rate cuts are happening. So RBI has got a green signal even from European Central Bank or Federal. They don't need an official green signal, but they were trying not to preempt or, prejudge Federal Reserve. So at least in that sense, I think next week we'll also have that signal. So all looks good, except that the two markets are very different. India is on a very different trajectory and US is on a very different path altogether. Samina.
Thank you, Anurag. You have a great Friday ahead and a good weekend too. We'll catch you soon. Well, that's what we have in terms of the global setup. This morning, the belief is that the US economy is looking healthy and there's no concerns or reasons to worry. Back home, of course, it's risk on trade. Maybe the transitional money that's been released from the Bajaj Finance IPO has been released, and that could be, helping Indian equities. But in terms of a quick mention on flows, like Niraj alluded to, it's been very, very healthy in terms of the buying that we saw yesterday. Foreign investors bought to the tune of 7,695 crores, while domestic investors took some profits and money off the table to the tune of 1,800 crores. Well, a quick recap of how the street was. You've pretty much understood where the markets were and what they were getting up to with our conversation in the early part of the show. But the markets had a field day, to say the least. The Nifty went home with gains of 1.89%, with most of the heavy lifting being done in the second half of trade, in the last 2 hours to be precise. The Nifty made a new record high, didn't sustain at that level, but finally went home to close at 25,388. Well, what you also want to keep in mind, yesterday was a Nifty weekly expiry, which probably helped or was a trigger for the bulls to ensure that the close for the week was solid. Apart from that, it was a broad-based rally. Broader markets, though, underperformed the benchmark. It was one of those days when all the Nifty 50 stocks went home with big gains. Nifty metals led the market, rising 2.9% on back of higher global commodity prices that we saw across Asia in early trade. PSU banks that have been on the sell side for a number of weeks now also did see some buying. Bajaj Auto was your big gainer in trade, made a new record high gain for the fourth straight day. Bharti, Hindalco, RIL, HDFC, ICICI Bank and even Infosys finally participated in the party. Nifty Bank rose 2.2%. It was about time. It's up 2.2% for the week and it's had its best performance, I believe, since June this year. Zomato, Thermax, MTNL, Kalyan Jewellers were some of the big gainers in the broader market. Granules, of course, had a rough 16% cut in trade and Hunasa came in with supply. Stock, of course, declined, but the supply did get lapped up, Niraj.
Yep, it was very strong. And, stocks like Granules have issues when on a day the markets did what they did, it was down about 16% or thereabouts, so, or 16% actually. So we discussed the big move, the ECB move, even though the ECB has said that they are not committing or pre-committing to the future path for rates, but that is that one big thing that has happened in trade. So what does that plus the flows that have come in imply for trade today? Remember, we already mentioned this, but FIs put in nearly 7,600 crores worth of capital to work in trade yesterday. So the FI long short ratio is at 65.52. So even on the derivative side, there's been serious buying that happened in index futures as well as single stock futures from the FI side. So the bent of the global investors seems to be on the long side when it comes to India. In fact, you see banks seeing the first whiff of serious performance on, and I would presume that is the FI buying impact that happened in trade yesterday, closing above that 51,500, which has been a key point of resistance, with even HDFC Bank participating in addition to ICICI and some of the others. So that was heartening to see, really. And let's see if there is follow-up action. I mean, SBI, HDFC, everybody participated, which is actually a great sign. And very likely that if this bout of outperformance is to continue, that large caps will now start outperforming the SMIDs or the small and mid-cap stocks quite convincingly, because we saw that in trade yesterday, that the Nifty was up about 1.7, 1.8%, but the SMIDs were a tad bit lower. The small cap index was up just about 1%. So we saw a bit of outperformance in trade yesterday. Let's see if that continues. And just a pocket to watch before we get to specific stocks. Just look at jewelry with gold hitting new highs and the kind of enthusiasm around some of those stocks, because it's the start of a long wedding season and analysts are baking in better demand trends on back of the customs duty cut. So both of those factors leading to some of the analysts really giving it a thumbs up. So Citi, for example, raised Titan's target multiple to 65 versus 55. Kalyan, Samina, we saw what happened in trade yesterday, right? HSBC raised the target price, promoter brought in the latest block deal. That stock was up 5% after rallying so strongly. So somehow this gold price movement and jewelry stock seems to be making this a pocket to watch as well.
Yeah, and strong upgrades as well coming in from brokerages. Just to add to your list of Kalyan and Titan, PN Gadkil, it's going to be the new boy on the block in a few days from now. It was highly oversubscribed, and remember, it's a significant play in Maharashtra, so it's still a new kid on the block, but the subscription numbers, if they're anything to go by, are out to indicate that anything that is showing potential for growth is getting lapped up. Just talking about a few more counters that we should be tracking in today's day of trade. Stock-specific news may be rather limited. A lot of it is brokerage-related in that sense in terms of reaction and broader trend-related. Niraj has already highlighted why jewelry stocks could be one to watch for. I just throw in oil and gas stocks as well. We've, in fact, Niraj talked about this before we go into specific names, is OMCs. They haven't participated despite the fact that crude was declining and declining very sharply. Of course, there are reports and indications there could be a fuel price cut coming, and that could explain why any sort of upside was getting sold into on an HPCL, BPCL or an IOC. Mika's done a little bit of work on this, so we'll bring her on to explain to our viewers of what this means for oil companies and, of course, what it means for stake and stockholders of these stocks. But apart from that, a few more to watch for in trade. You've got jewelry, you've got oil and gas, there might be paint stocks that may be on the sell side on back of a recovery in crude. crude, and tire companies as well may not have it great. Implied Nifty indicating to a flat to slightly higher start. Power Grid, keep an eye on this one. They have won a deal for augmenting of transformation capacity in Gujarat. It's an important one. It's a large deal from what we understand. Over the course of the next couple of hours, we will get an indication of what this means for the financials and the time horizon of this deal for Power Grid. But significant in that sense. The stock, of course, like every other stock, went home with gains in yesterday's day of trade. Nazara Tech, this could see quite a bit of movement in early trade this morning. They've reported to the exchanges that they're looking to invest 982 crores in Moonshine Technology. Moonshine Technology, remember, is the parent company of Poker Bazi, and they will acquire 47.7% stake through the secondary market and will inject 150 crores in a primary capital into Moonshine. So this is going to be a big acquisition for them, revenue accretive from the get-go. Mostly, the stock went home with gains of 5% yesterday. Further gains could not be ruled out today. The next one is a smaller company, but it's a pretty large order win. Edgy Infra. They received an LOA from the Central Railway and awarded a 715 crore order from the Central Railway authorities. And the construction period of this is 30 months, which means the cash flow on this order is also not too long, about 2.5 years from what we understand. So, Niraj, that's what I have. 3 stocks. Hopefully, we will react to some news triggers this morning.
Yeah, it could be interesting. So watch out for these, of course, the list that Samina has pointed out. In addition to this, there are, like I said, jewelry remains a pocket to focus on. So that's one on my list. Watch out for Titan in particular, because Citi has upgraded the stock, the target multiple to 65 times versus 55. But watch out for Kalyan Jewellers, watch out for PC and some of the others. So that's the first on my list. Panacea Biotech could be interesting because USDFC has committed a $20 million loan, by the way, to the company for expansion purposes. This is the nature of the entity giving the loan, makes it very, very interesting. So that's the second stock on my list. And I'll watch out for the telcos because they were very active in trade yesterday. Bharti Airtel was amongst the top gainers, or probably the best performing stock on the index. Bharti Hexacom was up as well. And the notes that have come out this morning from Jefferies is interesting. So Jefferies has reiterated a buy call on Bharti Airtel. The target price has been upped to 1970 from 1760. Amongst other things, they believe there are multiple tariff hikes in the offing. So watch out for Airtel in the session today as well. And watch out for Hexacom, which has gotten a Jefferies upgrade to a buy rating. The target price has been upped from 1260 to 1600, with the current price being 1291. They say it's the best play for playing tariff hikes, and the target upside at 1600 means that the upside is to the tune of 29%. So I'll certainly watch out for this one as well in trade today. So these are amongst the key stocks. Then, there is a note from Jefferies on Zomato, or Samvardhana Motherson, which has seen a series of downgrades. All of stocks will be in focus, but my top 3 were these.
So when news flow is slow, brokerages come to the rescue of the street in some sense. But another couple that I want to just very swiftly add is BLS International. It's a small company, but they've also gone out and made a significant acquisition where they are going to acquire 100% stake in Citizenship Invest, which is a Dubai-based firm specializing in investor programs for the Golden Visa over 15 countries. This acquisition is valued at about 260 crores, will be funded through their internal accruals. So this is one more counter you want to track. Went home with gains of 5% yesterday. Maybe the market had a whiff of this deal. Well, just a quick mention on the other one that I think could see a little bit of a reaction in that sense is HCL Tech. The company has announced the acquisition, again, 100% stake buy in Zena SAS, which is a software company based in Paris at an enterprise value of 23.9 million euros. Niraj, also a couple of other stocks that saw big blocks yesterday. Honasa, of course, saw some of its early private equity investors sell stake. So you had your Firesides and Stellaris that took their exits timed in line with what regulation allows them to do. But enough and more supply that did get snapped up quite well from what I understand. Even though the stock went down, this morning should be seeing some recovery on back of that overhang being behind them.
Yeah, let's wait and watch if that were to happen. Speaking of block deals, just lastly, Patanjali might also be a stock in focus today because of the block deal. But as Samina highlighted before, the potential good news for everyone in terms of consumers is that there could be a cut in petrol and diesel retail prices, which have remained unchanged since March 2024 and fixed for the last 28 months. This possibility comes in after the commentary from Oil Secretary. Mihika, what has the Oil Secretary said? More importantly, what is the impact on the related stocks?
Good morning, Niraj. So, Pankaj Jain, the Oil Secretary, has stated at a recent event that fuel companies may consider cutting and reducing retail fuel prices if the global crude or oil prices remain on the lower end for an extended period. He also said that India is also seeking higher OPEC output and maximizing their cost-effective crude purchases from Russia. Now, just context for the viewers, crude prices are down 16% since July of 2024 itself. They also dropped to a 33-month low earlier this week. Now, lower crude prices are positive for IOCL, BPCL and HPCL as it helps their marketing margins. Now, the government may cut diesel prices in the range of 2 to 3 rupees per litre, and the reason have been the lower crude prices and OMCs experiencing higher marketing margins because of that. When we talk about when the fuel rate cuts could come in place, well, according to MK, they expect retail prices amid the upcoming state elections, the prices to be cut only towards Diwali before Maharashtra's election model code of conduct. And when you talk about how the impact on the oil companies are, where they're seeing strong marketing margins currently. Now in Q1, the petrol and diesel marketing margins ranged were at 5 and 4 rupees per litre. July and August, we saw an increase of this, and and September was when the companies have been experiencing supernormal marketing margins because of the lower oil prices. Petrol marketing margins at 15 rupees per litre, diesel at 13. So the Q2 expectations are also healthy at 10 rupees per litre for petrol and 8 rupees per litre for diesel. And lastly, I'd like to end with, even though Brent prices have recovered from the 33-month low, they're currently trading at $72 per barrel. MK believes that the company could still yield 5 to 7 rupees per litre of margins in Q2 FY25, even if Brent or oil prices average at $75 per barrel, and even if margins get impacted by the potential price cut due to the fuel rate cuts.
Well, let's see. It's a sector that fundamentally should benefit, but the price action, a clear indication that the street is in no mood to give a thumbs up to the oil marketing companies as yet. So let's see if today is a different day or does it remain the same. Well, a small shift towards the macros, because that's important too before we shift back to the micros. Rising vegetable prices continue to drive retail inflation higher. August data shows that CPI inflation has surged to 3.65%. Pallavi Nahata joins in now with the details. Pallavi, what are internals looking like?
Right, inflation for the month of August has come in at 3.65%. That's for the month of August, and that's compared to 3.54% that we had seen in July. A Bloomberg poll of economists had pegged inflation to come in at about 3.4% for the month. In July, we'd actually seen inflation fall to a 5-year low. And this month, in August, despite the uptick, inflation does actually continue to remain under the central bank's target of 4%. Let's have a quick look at some of the key internals. Food and beverage prices saw a 5.3% rise in August. That's compared to inflation at 5.1% that we had seen in July. Vegetable prices also saw an uptick, coming in at 10.7% for the month of August. That's compared to 6.8% that we saw in July. Core inflation, that excludes the volatile food and fuel components, came in at about 3.44%, not too different from the print we had seen in July of 3.41%. That's according to Bloomberg. But essentially what this means is, because this print was impacted by the base effect, inflation is likely to inch up from here on. That's the reason why the RBI, or the Monetary Policy Committee, might not choose to cut rates when it meets next, despite the fact that inflation is currently below target.
Okay, well, so that's inflation inching up to 3.65, but remember, it's a very fluid situation. Very likely the next month's data could actually look much better on the inflation front as well. Remember, October is something that a lot of people have said is firmly on the table when it comes to RBI's side. But I must say, as much as yesterday's move on the markets and fund flows was impressive, I think what remains the most impressive thing in the Indian markets is the surge of applications for the primary market paper. Now, one more in the offing. One of India's largest private multimodal rail-focused logistic firms, Western Carriers, is coming out with an IPO today. Samina, what can you tell us about Western Carriers?
Oh, like you said, it's one more in the offing. I think yesterday was an aberration when we didn't have an IPO actually opening on the street, and that could explain why the secondary markets did as well as they did. But this one's an interesting one, not a very large one, an interesting industry, not your typical sort of company in that sense. Quick details on Western Carriers IPO. This IPO opens for retail subscription today, which is 13th of September, and closes on the 18th of September. The company is looking to raise 492 crores. The price band of this issue is in the range of 163 to 172 rupees per piece. The anchor book investors managed to do quite well. The anchor book investor has included names such as Kotak, Motilal, Aditya Birla Sun Life, amongst many others that participated in the offering. Let's remember that this is one of the few IPOs that haven't got too much international subscription in that sense in the anchor book. They did successfully raise 148 crores from their anchor investors. Now, why is Western Carriers looking to raise funds? The first thing that they're looking to do is repay, or early repayment rather, of the debt that they owe. Capital expenditure may be required as well because they've got very aggressive plans, and one way for them to grow and increase market share is by going out and making acquisitions and growing inorganically. They're also talking about purchasing commercial vehicles, a 40-feet specialized container and a 20-feet normal shipping containers and reach stackers. So that's what the objective of this issue is. Now let's tell you what Western Carriers does in a nutshell. The company, like Niraj said, is one of India's largest private multi-modal, rail-focused, 4PL, asset-light logistics firm. In terms of container volumes handled or operated by Western Carriers, it controls about 4 to 6% of the market share as of FY23. Well, 2 to 6% of the market share. The company also provides chartering services to overseas destinations. They also provide stevedoring services at the ports and the coastal movement of cargo across the country. So they do a lot. They're largely in the business of logistics, which is, remember, a rather fragmented one, at least right now. But if India does aim and urge to become a destination in terms of, a hub of the world, logistics will play a very, very significant role, and hence Western Carriers IPO becomes an interesting one from that point of view. Well, let's tell you what the outlook for the company is. They have seen they've seen decent, rather healthy volume growth in the last financial year. So there's been an uptick, but let's not forget the year before that, they actually lost volumes and saw a decline. So you want to keep that in mind, and the volume growth last year came largely on back of an acquisition that the company made. They do look to increasing volumes as we go along in the next 2 to 5 years by increasing the number of opportunities that they come across. Also, favorable government initiatives such as the GSNMP, the National Logistics Policy, the National Rail Plan, and the dedicated freight corridor will support the expansion efforts. They have a large number of clients, about 1,647 clients is what Western Carrier has. A couple of risks that you want to keep in mind. The company depends, so while they have 1,600 odd clients, they depend largely on the top 10 clients, and hence there is that key consumer or customer risk in their case. They also service an industry which is largely FMCG, so if there are any changes in that sector, their financials will be impacted. They don't really have much of an ability to pass on costs, and hence any sort of disturbance in logistics input costs like raw materials, like crude, could impact the financials of the company. They also have a significantly high number of working capital requirement days, and an inability to meet any of those could reflect badly. What we had noticed that in the last year, the finance cost also was quite high, which, as expected on back of repayment of the debt that they're planning to do post raising these funds, will have a direct impact on a reduction in financial costs and better operational performances. So all in all, it's an interesting player. It's a rather diversified clientele, even though the top 10 clients contribute a big chunk of their top line. The industry as well is full of many small, unorganized players on one hand. On the other hand, they have the big daddies who have economies of scale. So this is somewhere placed in the middle. But I guess the promise of growth is what keeps this one going, Niraj.
Well, growth is the panacea for all things, including high valuations, including subscriptions, and including stock market performance. It may have been very strong, but if there is growth, stocks are surging, as we've seen yesterday in a clutch of names. I mean, what explains Keynes Technologies, which is trading at 150 times earnings, surging 6% in trade, or 10%, excuse me, not just 6%. So growth is the panacea for everything. But Samina, I'm really keen to know what is the FNO data saying about the markets after this ferocious up move yesterday.
I think FNO data can take some credit because it did indicate in the early part of this week that there was some hope for banks, because that's what we'd seen when we looked at where all the activity was around the futures and open interest space. But of course, some may argue that last rally came out of nowhere. Within minutes, the market had made record highs and of course eased off from that. But the sentiment was very clearly there to stay, as that you saw the Nifty weekly expiry yesterday. Well, a quick check on what happened, what led to the gains, and how we are setting ourselves up for this morning. This is the first time in about 7-8 days the Nifty futures are trading at a discount, while you've seen an increase in open interest of about 10%. So clearly indicating that the upside now from here is rather limited. The markets will be taking a break. The bulls may not want to take aggressive positions before they go into the weekend. So not surprising that this is how the picture looks in terms of September futures at a discount, and the OI is seeing an increase as well. Well, also a similar setup for Bank Nifty. So what you could be arguing is that there could be shorts coming up in place. Nifty Bank futures are down, about seeing a discount of 13 points, and open interest is significantly lower, 12% drop in OI. So positions off the table. The outlook for the interim, or today at least, may not see the bulls trying to achieve new record highs in trade. It could be a day when you would consolidate, very likely with a negative bias in the second half of the session. And also just before the weekend, traders don't like to take on very aggressive positions. In terms of the spread of OI, I mean, look at the screen, looks so much more different from it did yesterday. 25,500 becomes the most interested level on the call side. This was at 25,000 yesterday. So we've suddenly moved the range in that sense, if I may say. Maximum call OI, so maximum open interest, was seen at levels of 25,500, which means that this becomes the next sort of resistance for the street. On the downside, this was sitting at 24,800, 24,900. But for now, that has also lifted up by about 100 odd points. And your base for the near term is at 25,000. So the trading range is between 25,000 on the downside and 25,500 on the upside, looking at the way the calls and puts are spread out. Well, apart from that, you also saw some activity that emerged in 25,600 and 25,400. But the spot of maximum action continues to remain at 25,500 on the upside and 25,000 on the downside. A whole bunch of stocks had a field day in trade. In fact, your Nifty 50 counters all went home with gains. And as you can tell, barring Granules that had it very rough, where you saw short built up, most of the counters have seen trades on the long side. Page Industries, Canfin, Bajaj Auto, Bharti, Airtel, to name a few, saw aggressive long built up. Well, you also had a similar picture for an SBI and Axis Apollo Hospitals, RRL, Kotak Mahindra Bank, which saw a decrease in OI and saw short covering in these stocks. So further upside on these counters is what you could expect as traders covered their shorts in yesterday's up move. So all in all, good-looking market. Some may argue it was short covering led, but that also means that the bets clearly have now moved to the upside, with 25,500 becoming an important resistance for the bulls. Well, we have with us Amit Goel of Amit Ventures now joining in. Amit, hi, good morning. What led to that breakout trade in the second half of the session yesterday? Everyone had talked to all through the week. Nobody was anticipating the markets breaking the range so quickly, right? What does it look like? A new trading range on the cards? Fresh longs can be initiated?
Yeah, hi. Good morning, Samina, and thank you for having me again. Last we met on Tuesday, The view from our side was that we are constructively bullish, and we were looking to build a long position in Bharti Airtel as well as in Bank Nifty, the two trading calls that we had given. I'm happy to report that both of them have worked out in our favor, and traders who have taken those positions must have made some money. If you look at Nifty's chart structure and the price action, we have now made a new high. And the structure is firmly indicating that we are now in uncharted territory with a higher high and a higher low sort of a formation. Since we are in uncharted territory, it's very difficult to understand where the resistances are. However, the bias continues to remain on the upside, and any sort of cooling off or time correction in the underlying, I would look to build fresh long positions for targets of about 25,600, 650. 25,500 happens to be, as is the want, a resistance for the near term. I do have a trade for Bank Nifty. If you allow me, I'll share that.
Yes, please, Amit. And also, help our viewers understand this, right? We saw a good move on the Nifty financial expiry day this week. Then on Bank Nifty weekly expiry, there was pressure on the index. Yesterday, there was a sharp recovery. But when I look at the F&O picture right now, September futures are at a discount. There's a sharp decline in the OI as well. What does that mean? Do you feel like there is long unwinding, and from now till maybe in the next few days, you may see some pressure on the upside on Bank Nifty?
Absolutely, you're right. This entire rally, if you notice, Bank Nifty has given a couple of short covering rallies in this week, which is a little surprising. And that is the reason why the futures are also trading at a slight discount. I do believe since yesterday the price move was so sharp and furious, the discount has manifested itself. I also believe that these two prices, the futures and the spot, will kind of converge. The question is whether the spot will catch up, whether the spot will come down, or whether the futures will catch up. My bias, considering the price action and the structure on the charts, is that the futures will continue to move up and catch up with the spot. Having said that, I do have a bullish view on Bank Nifty, because if you look at the Bank Nifty's price structure, even Bank Nifty has now, with yesterday's furious rally, created a structure which is higher high and higher lows. Technically, it is a long, it's an uptrending indicator. Given that, and since I do not see any major resistance before 52,500, 52,000, I believe that there is some more room on the upside. Playing for this, I am suggesting that traders can consider building a bull call spread, a limited risk strategy in which we will buy a 51,600 call, beg your pardon, of this 18th September expiry, and sell one lot of 52,000 call of 18th expiry again. We'll keep a target of 3,000 rupees, and we will also keep a rupee stop loss of about 3,000 rupees to begin with. I will advise the traders not to rush into this trade, because since this is a short covering rally yesterday, we might see some bit of profit booking of early entrants in this rally. So any dip and a reversal or a basing could be an opportunity for us to initiate these longs.
Right, Amit, was largely short covering led, and what we could expect today is long unwinding, if at all, in trade. Well, what stood out for me on your call is Jindal Steel. After many days, I'm coming across a constructive, bullish call on a metal stock. I know metals gained sharply yesterday, but what's the outlook? You're anticipating further upside on Jindal Steel?
Yeah, I'm purely playing the momentum game here. The structure, again, in most of the stocks, if you look at the counters, the structure has changed in Jindal Steel also from a lower high to a higher high and a higher low. Along with this, if you notice the option chain, if you look at the build-up, it's clearly pointing towards a long build-up in this counter. It has, of course, fallen and has been depressed. The entire metal stock sector has been depressed for the last couple of months. We are seeing some signs of recovery here. So I'm trying to play the momentum here, in which I'm suggesting traders to set up a bull call spread, given the build-up in this counter. So what traders could look to do is buy one lot of 1,000 call of the 26th September expiry and sell at 1,020 call. Even here, I am looking at a target of about 3,000 with a rupee stop loss of 3,000 again. The structure and the open interest build-up leads me to believe that any minor dip in this counter can be considered as a good entry point for this.
Any dip should be bought into in that sense. It's a bull call coming in on Jindal Stainless. Like Amit said, he's playing momentum and hence recommending that stock. What about HUL? So you've got one risk on and one risk off trade, I notice. What is the view on HUL? Constructive on this one too, I believe?
Yeah, I'm bullish on again. Actually, it's very difficult to find a short candidate in this market with the kind of rally that we have had yesterday. Apart from Granules, which again, I mean, that is news-led, and the fall has been fairly precipitous. So I really can't, build further shorts over there. Hindustan Unilever and the entire consumption and FMCG space has been, an uptrend in the last 3-4 months. I continue to be, constructively bullish on Hindustan Unilever. Even here, the structure is very simple. It's creating higher highs and higher lows. Also, if you look at the open interest and the long build-ups, I feel that there is some more room on Hindustan Unilever to go on the upside. However, this counter has already had a very sharp run-up. So I would advise traders, be a little circumspect when planning this bullish trade. However, the trade is as follows. We would look to buy a 2940 call and sell a 2980 call. The profit target and rupee stop loss is again in my ballpark of about 3,000 rupees. However, we would want to wait a little, and any dip in this counter during the intraday could be looked at an opportunity to enter longs here.
Right. Thank you for that, Amit. Yes, these are a few calls coming from Amit Goel. He is constructive on Jindal Steel, playing momentum there, bullish on HUL as well, given the recent rally some of those consumption names have witnessed, and also a trading buy call or a long call on Bank Nifty on a dip. Well, one stock that Amit mentioned as well, which was Granules, it was one of your big losers in trade yesterday. With the recent suspension of its facility, it seems like all hell has broken loose. But Motilal, I believe, doesn't think so. Varsha is standing by with more on that. Varsha, Granules unfortunately didn't participate yesterday for reasons that were very company specific. But some brokerages are still constructive on the counter.
Well, yes, Samina. So yesterday we saw pressure on the stock. Now this due to the US FDA observation at their Hyderabad facility considering data integrity issues. But Motilal Oswal still has a buy rating on the stock with 20% upside potential now because it expects 36% earnings CAGR over FY24-26. Now the 6 observations were related to cleaning and maintenance, inadequate root cause analysis, document management and procedure for in-process controls and air purification units. Now, company is expected to implement remediation measures to address those issues, and the classification of inspection from US FDA to understand the sustainability of compliance with regulatory guidelines is awaited. Now, currently, the good thing is that there's no major product approvals pending from the side. Until date, Granules has gone through almost 24 US FDA inspections since 2009, and out of 24, Gadgilapur, this Hyderabad facility, has been inspected 6 times with voluntary action indicated or no action indicated classification, which is actually a good thing. This facility has a capacity of 23,200 tons per annum for pharmaceutical intermediates and 26 billion units for finished doses, and this contributes major revenue for the company and has presence for its global operations. Granules is actually focusing on building a niche pipeline in the oncology space and large volume products and innovative tech products and backward integration. This is the reason that Motilal is expecting 36% earnings CAGR over 24-26, and this is the reason that they have given a buy rating. But they do mention that this Gadgilapur inspection is a near-term hurdle for the US growth.
We'll watch out for this. Let's see if it reverses some of its lost fortunes from yesterday, Granules India, but clear slam dunk on this one. So do keep an eye out for this. Also keep an eye out on some of the specific stocks which are on our watch list. So let me start by telling you about the first 4. So HPL Electric is in focus, a 144 crore order for smart meters. Usually smart meter orders bring about some excitement. Watch out for this. Watch out for Panesha Biotech. USDFC has committed to a $20 million loan. Could be active today. HG Infra has gotten a Central Railway order of 716 crore rupees. Usually this stock reacts on order wins. Tata Power has signed an MOU with Tata Motors for ECVs, and therefore this stock could also be in focus.
Well, a few more to add to that list. Nazara Tech could be a big mover in trade today. They've put aside 982 crores for an acquisition in Pokerbazi. Bharti Exa, there's no stopping these names. Jefferies upgraded the stock this morning. The target price revised to 1,600 rupees. And PNB Housing, we told you about this counter yesterday. A big block took place. Singapore government has bought 0.5% stake in PNB Housing. And remember, there was a big brokerage upgrade as well on the counter yesterday.
Couple of negatives. Watch out for Patanjali, promoted to sell about 1.1 crore shares at about a 3% discount. Maybe this stock reacts negatively. And Samvardhana Motherson or Samil, Citi has a negative note, a negative catalyst watch. Investec has downgraded the stock as well. Do watch out for this one on the downside. Let's welcome in Kush Bora, founder at kushbora.com on the technicals, and Chakri Lokpriya of Red Strawberry on the fundamentals. Gentlemen, both of you, thanks so much for joining in. Chakri, I'll start with you on this one. This buying that happened yesterday, FI-led buying, what explains that? Expectations of a rate cut, ECB move, China saying a downgrade, lowering of the mortgage rates. What is it?
Good morning. I think it's all of the above. You saw that the ECB come in with a big cut. Now the US is talking about, of course, it's going to be a 25 basis points, 75% probability. But the glide path for the Fed is clearly a number of rate cuts between now and the next few months. Now, when all this happens, clearly, rate sensitives, which is metals, banks, cyclicals such as cement, export-oriented names such as chemicals, these are first to the party. You could say that, metals, there's a slight, there's a big Supreme Court overhang on some of the metal names. So the banking names don't have such problems. So I think, they've underperformed. So I think banking, some of the stocks will benefit as their NIMs will expand when RBI starts following the US Fed cut.
Okay. Kush, good morning to you. What do you do with the indices today, both the Nifty and the Nifty Bank? Do you have a strategy this morning?
Hi, morning, Niraj. Well, given the kind of momentum, the only way to play this is perhaps on the long side, right? I mean, you can't go short, you can't sit this one out. The only concern being that, yesterday also we were discussing that, there are a few technical parameters, at least on the Nifty, which aren't really, as comforting, namely a couple of negative divergences on the daily and the weekly setup, and the monthly RSI shooting over 80 once again. Last time it happened, the Nifty saw a cut of 4.5%. So a couple of these factors playing out, but from a very near-term perspective, the momentum very clearly is there. What happened yesterday could be, and in most, in all likelihood, will be a rare event. But that said, we've taken out the previous highs on the back of good volumes. I think from a near-term perspective, you could look at 25,550 and 2,700 as the next target. 25,100 is coming in as a good support. But as I said, I'm a little more constructive on the Bank Nifty, purely for the fact that we've seen a good range breakout on this one, while 51,800 remains a bit of a near-term resistance. We're very close to that. I think if we do sustain above that level for some time, I think another 1,000 points of rally can pretty easily be expected on the Bank Nifty. So I'm a little more constructive on the Bank Nifty, as long as on the downside now the resistance, which was the 50-day moving average, will act as a support. So 51,400, 51,350 zones, as long as that is held, you should continue to remain long. If you don't have a long position, you could consider initiating a fresh long position. Intermediate targets being 52,200 and then of course 52,800 as we spoke. So a little more constructive on the Bank Nifty.
How things change so swiftly, right? And you can't find liquidity. We've talked for so many days early this week as well, when you were very, very negative, both indexes, right? Now, of course, constructive on Bank Nifty. Now, of course, if most traders mustn't have been sitting long on the index, because I think the advice going out by most people was that avoid the Nifty, avoid Bank Nifty, the breakouts aren't happening, breaches are not taking place. Today, as we see it, there is a sense, at least on the F&O side of the data, that there could be some long unwinding at these levels. So there will be a blip from what I'm expecting either today or early Monday. If that does happen, are you constructive on Bank Nifty and recommending a long trade? And if yes, please share levels, because that just gets easy to actionable then for our viewers.
Sure. So, Samina, see what happened was on the Nifty, when we saw that pretty much, a surprise blip on the downside on Friday, that perhaps, put in a word of caution on the street and, in the mind of traders and investors. I mean, it was well warranted. It wasn't really something that, you would want to ignore. Such a big selling, completely out of the blue. But there too, the Nifty was actually respecting the 20-day moving average for the most part. So there, the caution was still warranted. Now, Bank Nifty was a slightly different setup, and we've been speaking about this, right? That the base for the Bank Nifty shifted from 49,800, 50,800 to another 1,000 points, which is 50,800 to 51,800. After the Friday blip, Bank Nifty was quite quick to recover and come into that same zone again. So I still believe that Bank Nifty has a lot more room. There's been a lot of squeezing that has happened, and hence you're seeing a breakout. Yes, after such a big rally that we saw yesterday, there's a possibility that you might see some profit booking today. But as I said, as long as these support zones of now close to 51,350 are maintained, you could stay long on the Bank Nifty. If you don't have a position, that's your stop loss, and you could very well go in for targets of 52,200 and 52,800.
Right. Implied Nifty is indicating to a 70-point gap up this morning. Kush, top trading strategies beyond the index this morning?
Sure, a couple of stocks, a mix of FNO and cash stocks. Ultratech Cement, this stock too, like the Bank Nifty, if I compare, has had a squeeze and then, broken out of the range. 11,500 was the resistance zone that it, took some time to cross. But yesterday, on the back of good volumes, was able to successfully close above that. So I think this momentum could continue. So for a trader, 12,000, 12,300 are the targets to look for. 11,400 is a good support zone, so that should act as your stop loss. On the cash segment, there is Shilpa Medicare. Now, this stock has had a phenomenal run, but continues to surprise on the upside. So, if you want to consider a long position, your targets would be, 910, 940, 875 is a good support zone. So that should act as your stop loss now.
Right, we'll take a quick break on that note. We'll come back here for pre-open. It looks like a positive start for the street this morning, so stay tuned.
We're back with India Market Open right here on NDTV Profit, and it's after a very exciting Thursday afternoon. The idea only is to see if we can build on from there. And I like one thing that Kush mentioned amongst everything else also, that banks and the bank Nifty still about 2.5 or maybe or thereabouts from all-time highs. Do we see this now being the bucket which will start doing well, simply because if the FI money is coming in, it finds its way into banks for sure, the largest weightage out there. Now, Chakri Lokpriya, are you a buyer into large cap banks currently? If so, is it private side or is it the PSU banks like SBI and BOB? Why or why not? Chakri, you're on mute, I think. Sorry, I can't hear you.
Sorry. A couple of things from a portfolio positioning perspective, which is one, all the underweights of the private banks, things like HDFC Bank, ICICI, those underweights will now kind of come to the neutral position by the FIIs because we need to manage some of our weights so that to lower tracking errors. Second, on the other hand, for the alpha, I think we will still focus on the State Bank of India, Punjab PNB Housing, Canara Bank, all the PSU banks, because their treasury profits will be the fastest to recover whenever there is a rate cut. And now RBI will cut sooner rather than later.
That's the word coming in on banks. We're gearing up a pre-open trade. It's expected to be a muted start with a small uptick in early minutes of trade. Remember, yesterday was a short covering red rally with new record highs being made in the last hour of trade. It's a little all over the place. We'll come back to it shortly. The Sensex lower, the Nifty higher. Bank Nifty and other sectors will be important. Tech stocks would once again be in focus on back of those global cues. Kush, let's talk about a few more stocks in trade, and I want to start with Tata Motors and Bajaj Auto. Bajaj Auto made a record high, 4 straight days of gains. Does it still look good? Would you play into strength and go long in Bajaj Auto? Kush, you're on mute.
Not at the current juncture. I would wait for a dip on this one. The stock's done phenomenally well, and the volumes have picked up. There has been positive news flow also going for it, but it's entered overheated territories now. From here on, the risk-reward ratio may not be as favorable. So I would wait for a pullback, for a dip, let's say close to 11,000, 11,100 kind of zone. So from a trading perspective, that's where, the risk-reward ratio will become attractive for me. The support zone come in at about 10,000, 700 odd levels. So I can place a stop loss there and then play for higher targets of 12,000. Not at the moment, perhaps closer to 11,100. So buy the dip on Bajaj Auto if and when, you get that. Tata Motors has had that dip. I think it was a couple of days ago when, Niraj and I had this conversation that, yes, there is room on the downside, the stock could fall, but 970, thereabouts is a good support zone. If you see the low that the stock made yesterday was also close to that 958, 960 mark. I think it's approaching these support zones. I think if you're an investor and if you're looking at a medium term to a long term kind of a buy, these dips in stocks like Tata Motors should be utilized as a buying opportunity. Not so much from a trading opportunity just yet, because yesterday was the first day after 8-10 sessions of fall that the stock was consolidating with a positive bias. From a medium-term perspective, yes, the stock is starting to look attractive technically. So if you want to start accumulating, this is a good level.
Chakri, Niraj and you discussed banks. Let's discuss tech stocks. If history has to have it, tech stocks usually do quite well after the rate cut takes place in the US. Some may argue that's already in the price because tech stocks have been doing well in the last couple of months now. But at the current juncture, keeping risk reward in mind, would you add any tech stocks to your buy list?
Absolutely, we'll still buy tech stocks, and I think tech stocks will now go to an overweight position amongst the portfolio, simply because it's a low risk way of investing. At the same time, there's sufficient upside in TCS, there's Tata Elxsi, Infosys, all the frontliners. They all have sufficient upside, a good 15-20% or less than 6-8 months from now. all the good news of the order book starting to revive, the margins starting improving. In any case, the rupee fall will also kind of a little bit help them. But more importantly, demand revival is key, which will come back, and therefore ITS.
Okay. The other tech and telecom has been the buzzing space. Now, let me get across to Harsh, who joins in right now for the top brokerage call of the day. And Harsh, I wouldn't be surprised if there is a telecom stock on your list.
Yes, absolutely, Niraj. Good morning. So we have, of course, Jefferies on Bharti Airtel, but the more interesting one is Jefferies on Bharti Hexagon. 25% upside from the current market price and 29% upside from when they wrote the note is what yesterday also quite a sharp move, and therefore that difference. But that's what Jefferies is really building in. What they believe is Jio's growth target may require some tariff hikes, and those may be on the anvil. Recent lead indicates that there's already steps being taken in that direction, which is obviously a positive. There's a rising focus on monetization for the sector as a whole. And of course, this gives more indications of hikes coming in 2025 as well. Now, Vodafone Idea's market share continues to fall, which is beneficial to Bharti Hexa. And by the time Vodafone Idea completes its network investments, it may further see market share decline. That's what really Jefferies is building in. And that decline could actually help someone like a Bharti Hexa. And therefore, there is a gap with regard to the need for higher both tariffs as well as lower market share, and that gap is what Bharti Hexa will bridge, is what, that's what Jefferies seems to be believing. So they are building in 2 tariff hikes in Q2 FY26 and Q2 FY27, and they are forecasting FY24 to 27 revenue at 19% CAGR and EBITDA at 25% CAGR. They're valuing Bharti Hexa at 14.5 times EV to EBITDA, target price 1600, 25% upside, near 25% upside even from yesterday's close.
Okay. Well, this is a stellar move because Bharti Hexacom was up about 4.5% yesterday, and it's starting off another 3.5% today. Chakri, you spoke about tech. What about telecom? Let's start with that. I'll go to Kush as well on these trades. But fundamentally, a Bharti Airtel, a Bharti Hexacom, it's almost funny, right, Chakri? Traders were betting on Vodafone doing well, and what has done really well has been Bharti Airtel on a relative basis from the time that the foreign investors or the investors put in money into Voda. So what's the call on an Airtel, on a Bharti Hexacom, on an Indus Tower, any of these?
You're right, Niraj. I think, clearly, what is happening is Vodafone continues to need a lot of capital to survive. Mind you, the key word here is survive, not grow. And that is clearly reflecting in the market share losses, the amount of capital raisings the company is doing. This is not clearly the backdrop for a company to go ahead and compete. And in that backdrop, companies like, there are only 2 or 3 companies in this industry. So Jio, Bharti Hexa, all these are taking away market share. Now, the whole industry is penciling in roughly about 10% tariff hike. So let's say next 1 year. But now there is clearly room to raise it much more because global rates versus global rates, etc., is still hardly a fraction. So which means when the raise rates more than 10%, then clearly it will benefit Bharati Hexa as well as Jio.
Kush, would you trade a Hexacom now that it has gone up 4% yesterday and it's starting off 4% higher today? So you're technically buying it 8% higher from yesterday's opening price.
But just before that, a quick word. I don't think your viewers would be complaining because Vodafone and Bharti was, a debate that I had with your fellow co-anchor. And every time I've voted Bharti, and, I don't think Vodafone's done anything. Bharti continues to do well. That remains a good pick. Any kind of dip or decline that you get should be taken as an opportunity to buy. Vodafone continues to reel under pressure. So you might want to keep a track, but then not really, something I would trade. Now, coming to Bharti Hexacom, you're right, and it does look like, a good stretch from yesterday's opening price, but from whatever limited data we have on the chart, it's not even close to overheated territory. So positionally, it'll not be a bad idea to play for 1420, perhaps even 1480 kind of levels on Bharti Hexacom. A good support zone comes in at 1270 kind of zone, so that's where you place your stop loss. The momentum continues to build, the averages continue to slope upward. For the moment, I think everything's going for it, so not a bad idea with a stop loss of 1270. Continue to hold or add Bharti Hexacom.
Add Bharti Hexacom, that's the word coming in. Chakri, what consumption name do you still think could see some value buying emerging at? I mean, an ITC, HUL, Godrej Consumer. I don't know whether Niraj talked to you about gold stocks, Kalyan, PC Jewelers, Titan. All of these are looking like still looking good despite the recent run-up, actually.
Indeed. I think consumption is more geared towards the Titans and the Kalyan Jewelers, because that is what you call sustainable consumption, and rather than FMCG. And FMCG, clearly they're not value. They're expensive stocks with no real triggers for growth. If there's no any new factor which will cause it to re-rate. So it's still buy a Tata Consumer, Varun Beverages, Titan and Kalyan Jewelers.
Titan, Kalyan Jewelers and Varun Beverages. Those are a few stocks that Chakri likes at the current juncture. Apart from that, Kush, what are you expecting on Granules today after a 16% fall yesterday? Do you feel like there could be recovery on the stock and one could look at it for an intraday up move?
So, Samina, I'd wait and watch. And, the only reason for that is that, with the kind of move that the market saw yesterday, despite, whatever news would have been, around the stock, it closed near the low point of the day. So, an hour and a half, into the trading session or towards close, when the markets were, phenomenal, the stock did not see any kind of recovery, any kind of an up move. So I would wait. I wouldn't be the first one to, jump and buy. For me, the key levels on this one are around 525. That's where a good support zone comes in. I want to see if the stock tests that. Even for the day, if I give it a miss and, if the stock bounces another, let's say, 5-7% maybe higher, I'm okay to give it a miss just to get that confirmation that yes, perhaps the worst is behind and the news has been factored in now. So I won't be the first one to buy. On the downside, I'm looking at a 525, 530 kind of a level as the next support zone.
Okay. Chakri, the oil marketing companies, even on a solid day of trade yesterday, didn't react. The market action is telling us that no matter how bullish people may be, the stocks are probably not in the mood to move up. If you had them in your portfolio, despite this crude fall, would you log out and get into something else as a tactical call?
We don't have them in our portfolios, and I don't think we'll add them to our portfolios. They are in very inexpensive stocks, but I think what's impending is probably a petrol diesel price cuts. Given that and given all that, it muddles up their margin profiles of the companies. While it's good for the economy and it's good for the consumer, so therefore stay away from oil refining companies.
Okay, this was just the oil marketing companies, by the way, that Chakri Lokpriya was talking about, BP, HP, IOC. So bear that in mind. Okay, since the pre-open rates have settled, Kush Bora, I'm tempted to ask you, you had given 2 stock ideas, yes, but if you had to bet on one stock for a trade today, maybe it could be an intraday trade or a positional trade for a couple of days, what would that one top stock idea be?
So an HPL Electric, I think there was a positive news as well on this one. Is looking up, and with this kind of a gap up, it is looking at a at a breakout of the recent fall that you're looking at. So that is one stock that I have on my radar. On the upside, you're looking at a 625 and 640 kind of levels as the targets here. On the downside, yesterday's closing perhaps close to the 600 level or a little lower. 595, that should act as your stop loss. So you could look at an HP Electric as well, a couple of other stocks also, but then perhaps I'd wait for the markets to open and settle, and then perhaps take a view. The buy on Ultratech and Shilpa Medicare continues.
Right. A quick check on Muthoot and Manappuram Finance as well. They should be reacting well to those increase in gold prices, 2.5% each on both those counters. Samvardhan Madhusumi has a downgrade, and that counter could be one on the sell side. HG Infra has won an order. The stock looks good in early sort of pre-open tick. So all in all, HG Infra is up 5% now. So it's looking healthy as we see it in early minutes of trade. But a couple of more stocks that we'd like to discuss, and I don't know whether you talked about metals, Chakri. How do you feel about it? Yesterday's gains, rather unexpected, could be on back of global commodity prices moving up. But with the rate cut around the corner, usually garners well for metal names. Any low-level buying amongst counters where you're spotting value? And this doesn't have to be a long strategic call, right? Anything tactical that you'd look to add to the portfolio for 4 to 6 weeks?
Yeah, from a tactical perspective, Jindal Steel and Power, JSW Steel. These are the couple of companies, because these companies do not have mining exposure where they have to pay up to the various states of Supreme Court ruling. Keep that in mind. Normally, if you didn't have the Supreme Court ruling, you would have gone out and bought all kinds of metal stocks, but now you'll have to be more selective.
Well, that's the call coming in on some of these mining companies. Kush, is there anything you like amongst metal stocks?
So JSW Steel, was looking attractive yesterday. The kind of move that it saw places it above some of the key averages. 960, is where it's opening. This is also a level where it has resisted previously. So if it does kind of sustain above this, then you're looking at a move towards 975, 990 also. But just a word of caution. Metal stocks have seen fair share of volatility. So do keep your risk management, practices in place. A stop loss for this one comes in at 935.
Okay, and metals might not be a bad play considering the fact that they led the rally along with maybe banks in trade yesterday. So Kush, thanks for that. Gentlemen, stay on. Maybe just taking quick opening thoughts from you before we thank you. But the first trades will be here soon. And keep in mind that while we'll start off on a much more sedate note related to the big bank close yesterday, the question is, can banks continue to do what they did yesterday despite a rather quiet start by some of them in the pre-open session? Here come the first trades. Well, flat as flat can be. The Nifty IT should come up on your screen because all the others are trading flat. So here's the 4 major indices, all of them flat. Bring up the small caps and mid caps just to see what's happening there. About 1/3 of 1% for the mid cap index, the small cap about 0.5%. I don't think there should be too much of a disappointment that there is no follow through. If it has to come, it'll come a bit later on as well. So completely fine. Let's pull up the heat map. I think banks are quiet and most of the market is quiet. You don't quite see a major reaction into anything at all. So the losers, Asian Paints, Adani Enterprises, Divi's, all of them down less than 1%. On the gaining side, Hindalco, JSW Steel, Tata Steel. So metals continue to rise and shine. There's some strength in Bajaj Auto. Nestle, TCS, Britannia are some of the others. But it's a very, very quiet morning. Samina, I guess I'll have to hand it over to you very, very soon because there is hardly anything to talk about on the Nifty. But for the fact that metals are doing well and Bajaj Auto continues its screaming run. What a move this one is having.
Yeah, so it's 5th straight days of gains. It hits a record high. But yeah, there's nothing to be surprised or worried about. After such a sharp move yesterday, the markets are taking a little bit of a consolidation break. Shouldn't be surprising because you've also saw on the futures and option side of things that there was long unwinding that data was indicating to, which could potentially mean that the upside for today at least may be capped. But who's to tell? If Europe opens up with a big rally, we may follow suit. But for now, it's an average-looking market. It's a Friday when traders may not want to take aggressive bets going into the week of a Fed rate cut. Media is looking okay. Real estate looks fine. Metals is gaining. Broader markets are performing better than the benchmark. Yesterday, the gains were led from the front. So large-cap stocks were up and about with all your Nifty 50 gaining and closing closing in trade. Today, of course, it's the broader market universe that is looking a lot more better than the benchmark itself. Lots of smaller stocks across the broader market universe that could potentially be the movers of the day. Let's talk about gold. Gold prices hit a record high. They were up 1% in trade, and on back of which you would imagine some of the gold counters to do really well today. Also, there happened brokerage upgrades. So the Titans and the Kalyans of the world have got brokerage upgrades. Titans flat, but Kalyan Jewelers is up 2.5%, and PC Jewelers, for the same reason, trades with a gain of 3.5%. The other space on back of gold that is active or should be active is gold loan companies. So Muthoot is up 2% and Manappuram Finance is up 2.5%. This is all on back of higher gold prices and the outlook for gold looking fairly bullish in the near to medium term. The other vertical that's in focus is Telecos. This week was about Vodafone versus Bharti for the large part of the week. Today, of course, you've again got a few long trades. Bharti Hexacom. Jefferies has upgraded the counter, raised its target price to 1600 from 1200, on back of which Bharti Hexacom is the big gainer this morning, up 7%. So very, very sharp up move into that stock as we see it. Granules was a big loser yesterday. Remember, all hell broke loose on back of a facility of theirs getting shut down. The stock sold off on large volumes. Motilal has come out and reiterated that they still like the counter despite what has happened to the facility. The stock and the investors not taking that to their heart just yet. The stock continuing to add to yesterday's sell-off, down about 3%, 3.5% as we see it. But it wouldn't surprise me at some stage the buying could come back into Granules over the course of the day. The other one that I want to pull up is AG Infra. They bagged a fairly significant order on back of which the stock is up 3.5%. Nazara Tech is talking about a pretty big acquisition. The stock should be reacting to that as well, 1% higher on that. And BLS International, they've acquired a citizenship company in Dubai. The stock rates the gain of 1.5%. Patanjali Food, I believe there's a block that's taken place. The stock is trading with a 3% cut as we see it. And Godrej Agro, not sure what's happening there, Niraj, but a 4.5% up move on Godrej Agro. I think there's a large trade there too.
Let's, these days some of these stocks don't leave, certainly leave you surprised sometimes with the kind of moves that are happening. But I must say, from amongst the Nifty 500, the stocks that are really making a move, Patanjali Foods on the block deal was expected to happen at a 3% downtick, and that's the way it is. On the gaining side, not too many names. Maybe a Macrotech, Vedant Fashion, Campus Activewear are amongst the key ones. Kim's is up about 5%, so that's probably the top gainer. Watch out for that. Okay, quick opening thoughts. Kush Bora, flat as flat can be. Nifty Bank marginally in the green. Anything that stands out?
Raj does. The stocks actually had a good run over the last couple of days, and today too, if you see, it's opened up. The volumes on open are also pretty encouraging. So I think this up move could continue if you're looking at it from a near-term trade perspective. Also, it's not a bad idea. 665, 680, the levels to look for on the upside. A tight stop loss at 635. So I think Raj, steadily but surely on the way up. So that's one trade that can be considered.
Chakri, we've spoken about all of the major indices. Real estate, a spate of QIPs have happened. A lot of companies have gotten successful fundraising done as well. Are you constructive here, or has it run its course?
Probably if you want to buy silk, you probably can buy DLF. The volumes for this, revenues will probably grow 10% for DLF plus the industry. So that's a good number, which is a GDP plus type of number for real estate. But other than that, stocks have really run up, including DLF, but there's still a trade in DLF left.
Chakri, Lokpriya, Kush Bora, gentlemen, both of you, thank you so much for taking the time out and being with us and giving us your thoughts. Really appreciate your time. Well, we may not be at life highs this morning, but we certainly notched in a life highs in trade yesterday. Let's welcome in Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers, with his thoughts. Manish, great having you. Thanks for taking the time out. I hope all is well.
Pleasure.
But not too much to complain, Manish, isn't it, with the markets doing what they are doing?
So the amount of liquidity that is there in the system, plus, reports suggesting that USD INR carry trade has also started. And given that US is about to cut rates, this can only get exaggerated. So I think it's liquidity. Liquidity is driving momentum. Momentum is driving sentiment. Sentiment again moving the markets higher, and it's now into a virtual cycle. I think the key point to note out here is where is the valuation comfort, and most of the sectors are trading at higher valuations, but valuations are always a function of liquidity. So I think it is basically picking individual stocks. There's no point taking a call on the entire market, but broadly 75-80% of the market is trading expensive.
Manish, hi, it's also Samina joining in now. One more thing that I heard on the street, and please tell me if you're right or wrong, is that one of the factors that led to that big move in the second half of trade yesterday was probably the release of 3 lakh crores that was blocked out for the Bajaj Finance IPO. Is there any truth to this? Because I'm assuming if foreigners have come in to subscribe to this, and if the money has now been released, they might as well wait till the Fed cuts rates and then take the money out, right?
I mean, look, there is interest in India, that is for sure. And obviously, liquidity that was stuck in Bajaj housing, could have got released second half yesterday or maybe today morning. Plus, the currency in the US doesn't look like too supportive at current levels. DXY is on a weakening path. So from that point of view, money is flowing to emerging markets, and a lot of that might come to India as well. And since large caps have not broadly done well in a while, we are seeing, more interest in large caps and primarily institutional money that could actually move the index even higher from these levels. Having said that, market cap to GDP, all those numbers have crossed all-time highs in India. So there has to be a word of caution around these levels. But it's basically the power of liquidity and momentum.
Absolutely. No one can fight momentum. We can just sit here and rationalize this differently every day. Manish, I know we've talked about large cap, and we've talked about large cap extensively from the mid of last year. Time and again, the anticipation has been that foreign money will come in, and when they come in, large cap is the space that goes up. But contrary to that expectation and belief, and I know a lot of portfolios were hoping and waiting on that, right? It's the broader markets that have witnessed outperformance. From where we stand, if we again hopefully lead from the front and the Nifty 50 becomes the first mover, where would the bias sit? What stocks would it be? Would it be banks? Again, that's a trade that hasn't played out yet after many months of waiting. Would you buy banks? If yes, would you buy private sector banks? And HDFC, ICICI, Kotak, still looking good for portfolio additions?
So, over the last few years, FIs have been net sellers. We have not got too much of foreign smart money or institutional money, so to speak. All of that has been primarily domestic money. And, the power of the markets has been led by the retail investor. And it's quite a matured set of investors, because India was coming off a low base, and numbers, the law of small numbers basically mean that small cap, mid cap segment growth rates in earnings were much higher than the large cap space. And obviously they have done much better than the large cap space. Now the valuations today, we are trading maybe 22 times FY26 numbers. Is that grossly expensive? No. In 2007-8, we have gone to as high as 25p on a 1 year forward. Can markets move to those high levels? Yes, it can. But 3 out of 4 names across the market, whether large cap, mid cap, small caps, are expensive. Out of 57 sectors that are there in. Where do we hide in this sort of a market? I think the idea is to buy into moderate growth companies at moderate valuations rather than looking to buy the best growth companies at the highest valuation. In this way, one can actually reduce risk. Sectorally, you can hide in pockets like banks, financials. This includes insurance or health insurance or fintech or platform companies in the fintech space. You could find shelter in IT companies because IT companies would likely do well beginning second half of this year, continuing into the first half of next year. And obviously rate cuts in US is only going to help. And the third is obviously a lot is happening in the pharmaceutical space, considered to be a defensive space. And India has got new growth triggers for it to carry forward. It's a very large space. So I think these are broadly sectors where one can find some solace. One dark space, dark horse, so to speak, is basically your housing, building materials. Post-election announcements last year, the space has been quite subdued. There has been correction. We have seen the interest that is there in mortgage finance companies. There's a precursor to what you could see in the actual housing space, across all parameters. So I think these are the 4 areas where I would find comfort. Taking money off the table in top-down brilliant sectors like your capital goods, defense, railways, I get it. It is a fabulous sector from the next 5-7 years point of view. But near-term valuations are probably discounting the next 5 years of earnings. That is to say, there has to be a lot of price and time correction if one needs to make money. So not yet there in terms of what the correction has to happen in this space. So broadly taking money out from that space. This is how I'll be actually strategizing my portfolio.
Okay, Manish. The other question is you spoke of USD INR strength. There is clear direction of crude, even if there is piecemeal bounce backs that happen. Does all of this therefore augur well for directional flows from the global side into India? Because we know that the domestic money is there. So that is continuing. Can global money come in because of all of these factors, because of positive Indian macro and rate cuts all happening, even at these valuations? And therefore, does it take the markets to bubble territory?
Surely can happen, Niraj, because as I said that if the dollar index is to weaken, and it has been weakening, emerging markets do tend to be getting the flows. And this has happened in the past, and obviously this time around also, this is likely to happen. In this entire equation, China is on a back burner. So the next big Indian market and next big emerging market is basically India. We have started seeing off late a lot of USD INR carry trade happen because they borrow in USD, and because interest rate cuts are happening, there would be a tendency for the dollar to even weaken further, triggering further carry trades into India. From that point of view, I think where will the money go? I mean, the first allocation will be to the large cap index names. It's going to be a beta play because you're clearly minimizing your risk and earning that spread. And this will have a bearing on your Nifty 50 and BSE Sensex, to say the least. There would be certain spaces which would get higher allocation within the Nifty 50 sectors where there has been some degree of underperformance. Margin of safety in terms of valuations are clearly there. The financial space, the IT, the pharma, and the others would within the Nifty would be slightly underweight. So in that I think the best way to play with this is basically smart beta within the index names. And that is how this is likely to play out. So it can go into a bubble territory because markets move on liquidity, and there's plenty of liquidity that's waiting to come to India. August was the first month that we saw that there has been institutional buying worth 35,000 odd crores net positive, and that augurs well, and it's a precursor to more things like this to come.
Well, music to the ears of the bulls. Great for fund managers, great for news channels to report on. So, well, everybody's happy. Manish, all the best for maybe a continuation of a very strong ride. But thank you so much for talking to us today. It was important to have you. Thank you for being with us. Well, that's the view from Manish Sonthalia. And by the way, so that's Manish Sonthalia's view. Samina, one more very interesting view. And the gentleman says that if the business has potential, why not hold on to it for a long time? This is InfoEdge's Sanjeev Bikhchandani, or dare I say, somebody who's gotten this consumer tech investment space completely right. He recalled a conversation with late Rakesh Jhunjhunwala and his investment in Titan as well. Listen into a slice of this exclusive conversation with Sanjeev Bikhchandani.
India needs patient capital. As an investor, we have to be patient. I recall speaking to the late Mr. Nalwala about 4 or 5 years ago, maybe 6 years ago. It was this COVID time and it was a Zoom call. I had just called him up. And he told me one very important thing. He said, Sanjeev, if you find a truly great company, then stay forever. You don't have to exit. And if you stay forever, you can make huge returns in the years to come. He said, that's how I made my returns in Titan. I stayed for a long, long time. I'm still staying. And you need to be very, very patient.
Right. And do you believe that both of these companies, in terms of your investment as well as in terms of their path to profitability, have overachieved what you would have thought of when you invested in them?
Not in 2010. If somebody told me that, listen, Zomato will be between $25 and $30 billion, I would have said you're smoking something. Right? Likewise for Policybazaar. So you can't predict the future. The question is, you stick with what you see, which is, are the founders good? Is the idea good? Is execution good? Can they make it happen? Now, what eventually turns out, you don't know.
You make it sound so simple, sir, but frankly, it's so hard to do. As we see with most investors, it's extremely difficult to do.
You've got to stay a long time. You've got to understand one thing. Most VC funds are 8 plus 2 years, 10 plus 2 years, right?
Yes.
But for a company from inception to IPO, very often the journey is 12 years, 14 years, 15 years, and then in the aftermarket, 3 for 5 years more. So, but you don't have 20-year funds. We had the benefit of being able to invest from our balance sheet. And therefore, we can stay forever. And a lot of the value creation, now, we went into Policybazaar in 2008. It's now been 16 years, we're still there. We went to Zomato in 2010, it's now been 14 years, we're still there. If we'd been a regular VC fund, we would have wanted to exit by 2016, 17. And we would not have realized this kind of value. So we are looking good because we waited this long. We are looking good because of the founders, because of the management team, because of the work they did. We are lucky and fortunate that they allowed us into the companies. So our contribution is a lot less than the management teams and the founding teams.
Right. So, your story is truly unique. You started off as an entrepreneur, started with Naukri. Thereafter, did a bunch of other very similar consumer tech startups, driving technology through InfoEdge. And thereafter started as an investor, started a completely new journey. That's so difficult to do. Just talk us through what possibly was your most challenging, one or two biggest challenges you faced in this journey.
So what happened was that we had IPO'd in 2006. We had this cash sitting on the balance sheet. And more cash, we were profitable, more and more cash was coming in every month. And the board said, listen, you better use this cash. You can't just let it sit there. So it was decided that why don't we invest in startups? Now, that was given to me as an add-on assignment in 2007. I was still the CEO of the company then. And I was told that you can invest up to 160 crores next 3-4 years in startups. Now, by today's standards, that's a small sum of money. But at that time, it was a big chunk of our treasury. In the next 5 years, we invested about maybe 200 crores across 7 or 8, maybe 10 companies. 2 of those were Zomato and Policybazaar. In 2010, I stepped aside as CEO and looked at investing full time. My biggest challenge then was, do I really have a job? But as the portfolio grew, it kept taking up more and more time. And I, over the years, made it a full-time job.
So what made you switch from founder to investor? You said you did that in 2010. So what made you do that?
I think, the other leadership in the company was ready to take over. The company had told me that, listen, there needs to be a succession plan. So I was 47 when I quit as CEO in 2010. And Hitesh was ready to take over, and he took over, and he's done a great job. So if you look at the market cap of InfoEdge from 2010, when Hitesh took over, to now, I think there has been a massive, massive increase. And all thanks to Hitesh and everybody else. And that's to me, of course, to some extent, Zomato and Policybazaar do contribute to market cap. But really that credit goes to the other founders of Zomato and Policybazaar and the management teams there. Now, there are close to 100 startups we invested in. Some of those will succeed and are succeeding and are looking promising. So I think over the next few years, we hope one or two more successes come out.
Well, that's one exclusive conversation to another boost for India's semiconductor ambitions after Prime Minister Narendra Modi highlighted his vision for industry at the Semicon 2024 event. Tamanna caught up with Regu Ayaswamy, Senior Vice President and Global Head of Internet of Things and Digital Engineering at TCS, talking about their vision and growth opportunities in the semiconductor industry. Listen in.
This is a place where there is a lot of excitement happening around the semiconductor arena and the semiconductor focus for India. TCS has been in this business for more than 2 decades, working with major global semiconductor manufacturers as well as equipment providers. We work with semiconductor equipment providers who actually make machines and devices that make the chips that is required for the semiconductor industry. And also we work with many semiconductor manufacturers who make those design and make those chips. In the role we see in TCS and today we play and we will be accelerating this role is to first in the initial part of the semiconductor life cycle, which is the design phase, where what we call the system on chip, SoC designs. So we'll be working with the major manufacturers and startups and many companies to design the chip, which includes several design phases. From the design, it moves on to validation and verification, and we will play a greater role in the verification and validation too. The chips then goes to the fabs, and the TCS doesn't have fabs, but we will be working with many fabs, including our own Tata Electronics fab that is coming up in a few years, to actually manufacture those chips. And in the manufacturing of the chip also, the fab, they call it, it involves quite a lot of processes, quite a lot of systems and data and analytics. And today, AI-led manufacturing in the fab industry is one of the prime goals for many manufacturers in the chip design industry. And we will be providing a lot of Industry 4.0, smart manufacturing, data-based solutions, analytics, and AI-enabled digital twins for manufacturing side. So in essence, TCS will be playing a great amount of role in the design of the chips engineering in the front, and also in helping achieving the maximum optimization using AI in the manufacturing space.
So just let me understand the journey, Mr. Ayaswamy, because if I see it correctly, the focus used to be more on the R&D side as far as TCS is concerned. But you're moving ahead to design and other value-added aspects. Now, how far do you see this going? And can you give us a sense of that journey as well?
Yeah. So the journey is, as I said, semiconductor is not new to TCS. We have been working with them over 2 decades on many areas. But I think what is really happening is, if you take the design, this is now SoCs are becoming very lot of applications. So we have autonomous chips that are coming for autonomous car industry. We have chips that are required for smart grid in the utility industries. We have chips that are required for medical devices. So in the front end, we are looking at the design phase or the R&D phase of designing the chip and ensuring the chip is getting manufactured in the plant. But we will also be working on the downstream application industries as well. So for example, we are building smart meters for utility industry, and those smart meters will have some of the newly designed chips which will carry AI on the edge. Similarly, we work with automotive industry. In the automotive industry, we look at, for example, there is to bring some of these autonomous features, we need high performance edge computing chips. And we will be, on one hand, participating on the design of the chips. On the other hand, we will also be developing those applications that are required for the automotive industry for realizing autonomous car features. So I think it's not just the R&D of the chip, we are also looking at the applications that are required. This is just one part of it. The other part I told is about the whole manufacturing also could be transformed because of the AI, and we can bring a lot of solutions that go into the manufacturing. There are a lot of process in semiconductor manufacturing, such as etching, polishing, lithography, and a whole lot of parameters, and it's a huge power consumption, huge opportunity for optimization. That's where data, AI, and cloud will play a larger role, and TCS would definitely be in the central part of that, playing that role.
You know, in terms of, and I don't know how much you can add to this, Mr. Ayaswamy, but from a future perspective, does this focus of TCS then become key? The company is already, of course, a leader on the software side, but the focus on semiconductors and Internet of Things and AI in the chip space, how big is this as a part of TCS's overall vision?
Yes, it would. As I said, in TCS, this semiconductor would come from different sources of opportunity and business for us. One is providing the R&D services and the chip design services, which we already have, and we will be expanding this multifold, because I think today I also am responsible for the Internet of Things business division. So we feel the proliferation of application-specific system on chip would be like expanding multifold. So that will be a huge stream, and we will be expanding our headcount as well as our capabilities, tools, and the knowledge on this exponentially. And similarly, if you look at the downstream applications that are happening in the engineering and R&D industries across all these industry segments I talked about, like medical device and utilities, as well as in automotive, we will see tremendous growth opportunities there. Third is not stopping there. We can also address the huge opportunity, because in India itself, there is such a large investment in semiconductor industry. Tata Group itself is making huge investments of close to 91,000 crore. And there are many other players also setting up those fabs and factories here. And TCS will have unique opportunity to work with them also to implement some of these solutions, not just overseas, but also here in India.
All right, that's the view from TCS on, well, multiple things that they are doing and the opportunities thereof. Now, we shift focus to a mid-sized name. Tega Industries, it's a mining equipment manufacturing company, aims to achieve revenue growth of 15% in FY25 and more going ahead. Samina and me caught up with the Managing Director and Group CEO Mehul Mohanka talking about the growth plans and the road ahead for the company. Listen in as we wrap up this edition of India Market Open.
What Tega does is what we call manufacturing and designing of products which are called critical to operate consumables in the mining space. For customers, we are an OPEX spend, so hence we are quite devoid from CAPEX cycles in the commodity cycles. And all of Tega's products are installed in what we call a mineral process plant in a mine. And we aid in extraction of metal from the rock once it's excavated from the mine. So that's what our business is. We try and define it as all above ground operations. So we're not in the excavation of rock from the earth, but processing of the rock to extract metals from the rock.
So fair assumption that with everything that's happening in your sector or in the metals and mining and commodity space, you're rather insulated from it, because it really doesn't matter if commodity prices are moving up or down.
Yeah, absolutely. So the best way I kind of position our business is that if you want to, as an investor, ride the commodity cycle without the risks of the CAPEX side of it, we are the best company in that spot because we have an OPEX related business.
So you're an Indian company with Indian roots, but India is not the largest mining country in the world. You've got Latin America, you've got Africa. Explain this to me, right? So you're based here, but you're servicing, and I'm assuming you're servicing countries far out. How does that dynamic work, and where does the experience come from?
So in the truest sense, we're an Indian-born MNC. So we have manufacturing locations in South America, in Chile, in South Africa, Australia, and about 7 manufacturing plants in India. And the reason for that is we try and always be closest to our customers that we serve, because as I said, it's a critical to operate product, so customers have huge expenses and liabilities if there is downtime on the equipment. So it's imperative that we are close to them, and that's why we ensure that we are as close to the customer as possible when it comes to serving them. So our ethos is about 48 hours from a phone call, we would like to be at a customer's site. Now, in India, the mining industry has not been growing as rapidly as it has across the world. So in India, I think our contribution of mining is less than 2% of our GDP. And markets overseas, because of the size of the plants, tend to be way larger than we have in India. And hence, the demand for our products has always been and will be much higher outside of India. Hence, our revenue mix is such, and it reflects that 85% of our revenue is exported, is non-India centric.
These are very unstable economies and dangerous in some ways. Is that, I mean, relative to India, of course, I mean, Latin America, Africa, do you hedge yourself? And also this landscape is evolving, right? You'd imagine this competition coming in, you might have geographical biases. Is that a risk to the outlook of Tega for the next 2 to 3 years?
Well, one can always be faced with geopolitical risks. Mining countries or commodity-led countries tend to be a bit more riskier than the others. But then we have been in the business where we've been able to de-risk ourselves from a geography perspective. So today, as I said, we have manufacturing bases across the world. We ship to over 96 countries today globally. So that itself is a diversification of our portfolio from a risk perspective. Coupled with that, we have multiple product lines which serve customers across metals across the world. Geopolitical issues will always be there in our business, but we've been around for such a long time that we've been able to plan and circumvent them over our existence so far. So I think that's how we look at it.
Well, what about the fact that China seems to be slowing down at a much more rapid pace than what people would have thought at the start of the year? Does that have an impact on the mining ops of companies which might be owning some of these mines? Because if the end product prices are going down, if the fortunes, as they say, are changing, do they go slow on the OPEX as well, or not quite?
Yeah, so China is a big market for mining, but we've intentionally stayed away from China because I've always believed that China is a one-time supply market, and we have a lot of inherent IP in our product, which I would not want it exposed in an economy which we cannot protect our IP in. So we've always looked at growth for ourselves outside of China. And today there are Chinese companies who are operating in our space, but they're at a much, much lower value add segment. So they're in a segment which we've already exited about a decade ago. So I think China for us is not that big of a factor. We've not always looked at China as being competition or a market that we would want to be in. But China has been leading a lot of growth in investments in the mining industry. So they do own a lot of resources and assets globally. And one cannot ignore them, but we would find a way of how we can still coexist with Chinese vendors.
Okay. So you had a fairly decent Q1, and I'm using that as a cue to just try and understand what you likely think of how growth can be over the course of the next, let's say, 3 years, or I don't know if it is possible to think of 5 years in such a volatile world. But I'm guessing while you talk about quarters at the end of every quarter, what is the larger vision, let's say 3-year, 5-year game plan, if you will?
So if you look at our past 7-year history, we've been growing at a CAGR of about 20-odd%. Right? And over the last 3 years, we've been guiding the market at about 15% CAGR. Of course, in the last 7 years, our base has moved up as well. Yes. So today we're roughly at about 1,500 crores at FY24 revenue numbers. And the intention is to continuously bring to the market new products that can help us leverage our operating capacity and at the same time maintain our margins. So the trick is how do we continue to grow at 15% and above and still maintain our healthy 21-22% EBITDA that we've been demonstrating so far. But I firmly believe that we do have the product lines, we do have the strategy in place. McNally is an equipment business that we bought to ensure that the growth momentum is sustainable, and we're quite confident that it will do so over time.
I want to talk about your product because I think a product mix or launching new products, discovering new geographies is probably where your next leg of growth will come from. One product that I read about and heard your interview across was Dynaprime. Give me a sense of what is the sort of growth you're expecting for Dynaprime over the next 2 to 3 years. What is the contribution of Dynaprime currently to your books? I'm assuming, again, low base, potential to grow is higher. Could this sort of help you scale and beat that 15-17% growth that you're aiming for?
So Dynaprime is a homegrown product line. We launched it in the market in 2018, and the intention of launching Dynaprime was to offer customers an option of using an alternate lining substrate other than steel liners. So in the grinding mill business, steel liners have been pretty much dominant over the past many decades for the lack of a better alternative. And in Tega, we were able to develop a product in-house from our own product stables that we could bring to the market with reasonable amount of credibility now and a huge reference base, which gives customers the confidence that there is a product that's available as a substitute. And the idea is to continue to push through with Dynaprime in the steel lining segments. So for example, we estimate the steel line market to be about $900 million. And we're just barely ex-China.
What's your market share in that $900 million?
We're just about scratching the surface. I think we're about anywhere between 3 or 4% as of now. So there's a huge upside and headroom for us to grow.
So in 3 to 4 years from now, where do you see that market share stand at? And what are margins here? Do you enjoy better margins because it's an in-house product?
So margins are similar as our existing product profile, but right now we're still in the seeding phase, right? We're still in establishing the product in the market. There's enough traction, but the idea is to get all the trials done first and then be able to improve on the pricing. So once the customers have experienced the product, have benefited from all the KPIs that we've been talking to them about, and assuring them of, then there's an opportunity to put the price up and have better margins from that product vis-a-vis other product lines. But Dynaprime is a product that we think is a product of the future. It is something that I think customers are going to greatly benefit from and is going to be a pretty new innovation in the market where we are cannibalizing the steel liners.
Okay. And what happens, I mean, in order to get this growth numbers that you've spoken about, we've not even reached the inorganic side, but do you need to expand the product portfolio meaningfully, or with the current set of products, Dynaprime and others, you reckon that this growth number is eminently possible?
So at any given time, we have over 8 to 10 products which are in our R&D stables. So we have a big push towards the digital space of using IoT sensors in our product, because I get more and more customers telling me that I need to de-risk my operation. And one of the ways to do that is to be able to have advanced warning systems, which tell them that it's an engineered product, right? So it has its own inherent issues of maybe there could be an issue with the product or with the plant. And how do we ensure that the customer knows about it in advance and can plan for it? So you have sensors in it which talks to the customer and can forewarn them if something is not right. So that's a big digital push that we're working on. Again, because I said it's a critical equipment that we supply our product to. And these are the initiatives that we're working on, which will ensure that our growth rates and margins remain sustainable as we continue to forge ahead.
Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat with our guest today: has the large cap pivot begun already? Would the festive cheer aid consumption, which certainly needs a bit of a kicker? And would the pharma focus in India continue, considering a slew of developments that have happened already within that space, including the Biosecure Act in the US and more? Let's talk about all of this and more with our guest, Ashish Gupta of Axis AMC, joins us right now on the show. Ashish, great having you. Thanks for taking the time out. Niraj here. I hope all is well.
Yes. Hi, Niraj. Thanks for having me.
The pleasure is entirely ours. Ashish, I'm asking you a bit of a here and now question, and then we move on to the longer term picture. But this sudden spurt of momentum that India got yesterday, and maybe some of the other markets too, is this preempting some rate easing cycles ahead of them actually happening, or are there other technical reasons for the same?
No, I think my personal belief is that, yes, definitely the outlook of the market because of the expected rate cut is positive. But what we saw yesterday, and particularly in the last couple of hours of trading, is more to do with the interlinkages the cash market has with the derivatives market, right? And we have spoken about this earlier, that the frenzy that is there on index options around expiry days in particular can drive volatility in the market. So I think we have to be careful about that and not read too much into the volatility that happens in the last couple of hours, particularly on expiry days.
Got it. Okay. The near-term reasons notwithstanding, Ashish, the fact remains that we are a market which on certain counts of valuation could be considered expensive. Though the bulls tell me that, hey, Niraj, look at the 10-year valuations, look at the growth that we are putting in. Why are we so egregiously expensive? We are not. So I would love to understand from you, Ashish, how do you think of the valuations in the current context?
Sure. So I think there's no dispute that if we look at valuation from a simplistic lens of just, let's say, a PE multiple, right? So if we look at the large cap indices, they are trading at about 21, 22 times earnings. The historic average has been around 16 times. So on that count, it is expensive. I think the other important statistic to note there is that if we look at the broader market, if we look at the mid cap and small cap indices, there the multiples are even higher at about 27, 28 times. The good thing, and where I will agree with the bulls, is that these high multiples have been well supported by earnings over the past 3 years in particular. So both in absolute terms as well as relative to what we are seeing in international markets, we have had a 23-24% earnings CAGR over the past 3 years. I think what we need to be careful about is that what is going to be the earnings growth going forward. And if you see the recently reported June quarter earnings, the earnings growth had moderated to about 8%. And if I look at consensus forecast earnings for FY25, that is averaging at about 13 to 14%. So I think that is why it's careful to kind of take these multiples into cognizance that the earnings growth is also slowing. And with the slowing earnings growth, one should not expect multiples to keep expanding. And if that does not happen, it certainly means that market returns will be more moderate this year compared to what we have seen in the last couple of years, notwithstanding the fact that global rates are easing.
Got it. Okay. Just wondering, Ashish, the first quarter aberration, I mean, it may spoil the picture, yes, for FY25, but I mean, most companies have said that the election related issues that happen in quarter one will get over. So does that spoil the party quite significantly from an earnings outlook perspective?
So I think you're right. First quarter was a bit of an aberration, and therefore it was only about 8%. But even if I look at FY25 and even the forecast growth for the FY26, that is broadly around 15% only. Right. And actually, the mid cap and small cap, a relatively faster growth is expected in those pockets of the market, because if you see the large caps, they are dominated by companies in the IT services sector, a few conglomerates, the banking sector, FMCG, and these companies actually are not growing that fast. The banking sector, we know, has seen some slowdown in loan growth. Margins have also peaked. So the fact is that in the last 3 years, we were coming off a very low base of earnings. And from this high base of earnings and profitability, the growth in bottom line will be more correlated to the top line growth that India is witnessing, right? So if the nominal GDP growth is going to be about 10-11%, then I think a 15% corporate profitability growth is reasonable to expect.
Okay. Now, viewers, I want to draw your attention to this chart. It also assumes some significance simply because on the back of a note that Ashish had written some time back, where he spoke about the kind of flows that have happened and the kind of selling that has happened as well from the promoter entities too. But this is an ISEC research note of a recent note, and it's based on data of top 1,000 stocks by market cap, and clearly shows that the flows from the MF side have been bordering majorly on the large cap end versus the mid caps and small caps. Not quite so much for FPIs, wherein there are outflows until recently on the large cap end. And then this crux here, right? Promoter entities, other foreign investors, all have sold out of large, mid, and small. Ashish, I would love to understand from the time that you first wrote that piece in a much more broader fashion, of course, but until now, does that give you a sense of things being different going ahead? Could large caps now be the central focus if indeed global flows were to strengthen and let's say the market stays stable or marginal correction as well? Could SMIDs correct or relatively underperform the large caps going ahead?
So I think technically where the market is positioned, and actually if you rightly highlighted that mutual fund flows on the large cap side have picked up, and you have had relatively more stable flows on the mid and small cap side. But I think really one big challenge which I referred to earlier is that the large cap earnings growth has been relatively lackluster. And so I think unless there is a huge disappointment in mid and small cap earnings, I think there will be attractive pockets of opportunity in that space. It, of course, comes with a fairly high risk because the earnings expectations are high. And which is reflected in the multiple, right? So we spoke about the fact that companies are trading on average in that space at about 27, 28 times. In fact, we had done another analysis that companies where earnings growth expectation is more than 20%, the average PE multiple is nearly 34 times, right? So if the company disappoints in earnings today because earnings growth is forecasted to be more than 20%, it's trading at more than 30 times. And if for whatever reason there's a miss in earnings or cut in earnings forecast, say 20% comes to 10 or 15%, you'll see a double whammy, not just EPS being cut, but the multiple will drop from 30 plus time to around 20 times. Right. So I think that's where we need to be careful in the mid and small cap space. So one has to be much more focused on companies where you have the belief that earnings growth is going to be there, and it is going to be there for the medium term.
Point well noted. Where is it Okay, so where do you believe the largest pools of profit exist, Ashish, let's say over the next 3 years? Because in some pockets, like you also probably partly referred to, and correct me if I'm wrong, that maybe in some pockets valuations may be expensive, but profit pools may be very, very large over the next 3 to 5 years, and therefore maybe a better promise of earnings growth. So where do you think the largest pools of profit exist, and where within the pools of profit relative to the existing valuations is there the largest degree of comfort for a large investor like you?
So actually, to be frank, the market does not really have too many undiscovered pockets, right? We have had like 7-8 years of consistently positive returns, so there is very few undiscovered pockets. I think the good news is that the market earnings and profit pools have become very broad-based, right? So if we kind of roll back 5-7 years ago, the profit pools were primarily sitting in a couple of areas, say the consumer sector, the retail space, or really the financial sector. And this has got broad-based over the past 4 years. So today you see various parts of the economy, whether it is investment-related, manufacturing-related, even pockets like real estate, besides consumer and financial. So the profits are very well distributed, and literally every segment of the market is today in terms of profitability. And now I'm not saying earnings growth, but at least in terms of profitability, near to its peak in its earnings cycle. So I think that is the good news. I think what we need to focus on themes that will be long lasting, given the multiples that are there. One thing that we have turned incrementally more positive on is consumption, because over the past 3 years, because of the relatively slow recovery post-COVID in that space, and the fact that other pockets of the market had come back from very low profitability, this part of the market had got relatively ignored. So I'm not saying that there was a distressed valuation, but had relatively underperformed. And here we are seeing a couple of opportunities. One, that there has been a cyclical pickup in mass consumption, so some early signs are visible. So you would have heard the commentary now that for many companies, rural consumption is outpacing urban consumption. You are seeing some segments now, like two-wheelers, consistently doing well, and in fact now two-wheeler sales are outpacing the growth in passenger vehicle sales. And the second big important driver in this space is really the benefit of increasing penetration and changing consumption patterns, right? So you look at segments like retailing, you look at what is being consumed, so the consumption basket, how it is changing for people, and even how these goods and services are being consumed. Right, so that has been a big driver of growth, and I think that presents attractive opportunities that will be long-lasting. So I think that is one segment we are incrementally more positive on.
Okay, sorry, can I just ask for some detail there? So two subsets of my next question, Ashish. One of them is this uptick that we've seen in rural growth. And some people say, oh, don't classify urban rural, because most of urban companies also have a rural presence and vice versa. So I don't know if you bifurcate that. So that's part one of my question. Part two of my question is what you just mentioned, that there are some interesting consumption trends emerging which could be long lasting. Now, is this only present in retail, or are they present in other forms of consumption too? Would love to pick your brains on that.
No, frankly, it is present in every form of consumption, right? So, for example, if you look at the four-wheeler sector particularly, right? So we had 5-6 years ago that the four-wheeler being dominated by compact car sales, right? So 60% plus 2/3 of the sales used to be compact cars. Today, if you see four-wheeler sales, more than 60% is SUVs. So companies that got that shift right have seen a multifold increase in their stock prices compared to relatively companies that are still more focused on the compact car segment. So I think this is present in virtually every segment of consumption, and not just say a few pockets of it. And sorry, Niraj, I forgot your first question.
My first question was on the basic aspect of rural growth, because data seems to suggest that rural is picking up. So is that data applicable for trying to make a decision on FMCG or staple names, or not really?
I think it definitely is. And again, with FMCG, again, we have to be careful about what are the changing consumption patterns, because for many companies, it's actually not just about the cyclical slowdown that had happened, but it is also about what are the goods and services and how they are being consumed today. So today you have seen the growth of D2C brand in many categories coming in, and that's actually taken the shine away from companies that just relied on their distribution network, for example. Right. So you are actually seeing differential, therefore, in growth rates in segments where D2C brands are meaningful versus in segments where there are no D2C brand. So FMCG companies in pocket where there's no D2C brand, you have seen consistently better volume growth. So I think we have to be careful in classifying every slowdown as just being because of cyclical reasons, because there are enough changing patterns that are driving consumption as well.
Got it. Okay. So just one last question on consumption, Ashish, and that is until about 6 months ago, the theme most favored was the K-shaped, the beneficiaries of the K-shaped consumption, and particularly at the premium urban end, right? Because those opportunities were cited to be multi-year, maybe decadal opportunities as India's per capita income grows. I'm just trying to understand, there may be a slowdown currently, or maybe out of fashion to talk about them currently, but are these indeed decadal opportunities? And would you be interested in investing in some of these? And if so, what are these? I mean, are they falling under indirect forms of urban consumption, or are there direct good manufacturers? Any insights here?
I think I still believe that those opportunities are there, and I still believe that they are decadal. And even as you are seeing some slowdown in urban consumption, in these pockets, growth continues to be fairly strong. One segment, and I know it might not be typically seen as consumption, but I even see real estate as a big beneficiary of this trend, right? And we believe that we are on a strong real estate cycle, and you will continue to see growth come in. I think one of the reasons why market has kind of lost some of the focus on this probably is that the valuations overall had moved up more materially in this segment, and there is a catch up as broader consumption is picking up. But I think the uptrend in the top end and the premiumization trend that we are seeing is certainly here to stay.
Okay, Ashish, now I'm moving tracks and trying to understand if tech and IT services becomes a part. And the reason I ask this amongst everything else is that the last 7 or 8 days, a clutch of sell-side brokerage houses have come out and said that they are now starting to turn constructive on IT services at the margin. Maybe even BFSI is picking up. November uncertainty on the US is probably a couple of months out. Post that, at least we will know which direction it is, and therefore that event is out of the way as well. Are you constructive IT services? Yes or no, and why or why not?
So we are actually still relatively underweight IT services.
Okay.
So we believe that yes, there is some visibility in terms of bottoming out of earnings and earnings growth. Given the fact that there are rate cuts, there is commentary, particularly in BFSI sector, global BFSI companies, that their IT spending is actually going to go up, and there's been some pent-up demand there. But even kind of putting all that in, we really struggle to see most of the IT companies being able to deliver double-digit earnings growth. If I look at multiples of IT services companies, so despite the fact that many of them were kind of had underperformed, the multiples for IT companies were still about 1.5 standard deviation higher than their historic trading multiples. So I think that has kind of kept us lukewarm towards the IT services companies. Within the sector, we believe, again, there are some companies that have better earnings potential, that are focused in a few verticals or products that are doing better. So we are overweight those. But on a sectoral basis, we continue to be underweight IT services.
And the same applies to ER&D and other forms of tech businesses as well, or is it only IT services?
I think ER&D certainly has much stronger growth outlook. I think companies have consistently delivered better growth, and the outlook is certainly better there than I think the larger cap IT services.
Okay, so ER&D better, but IT services itself, Axis AMC, is not that constructive on. Ashish, one more a follow-up really to an earlier answer that you gave, last couple of questions. You mentioned about longer-term trends and how four-wheelers and SUVs in particular are coming to the fore. But we're seeing, I'm trying to talk about the near term now, that we're seeing this dichotomy in sales between four-wheelers and two-wheelers. I mean, it's after a really long time, probably post-2019, that I'm seeing festive season discounts on offer in the four-wheeler companies. Now, are therefore four-wheelers a bit circumspect as an investment candidate? And conversely, could two-wheelers continue to do well? Just trying to think how you think about it.
See, I believe the discounting cycle that we are seeing is really reflecting the inventory cycle. Right. Okay. So there was a big build-up in inventory on the four-wheelers space. Last quarter, the retail sales on the four-wheeler disappointed, and there was a big inventory build-up, and that's kind of led to the discounting that has happened. I think once the inventory clears up, you will see the discounts also fade away. I think the interesting question, though, still remains that over the medium term between, I think the two-wheelers and the four-wheeler space, where one would be, I think we have positions across both the segments, and the way we are playing the auto sector is not really just looking at we want to be overweight two-wheelers or four-wheelers, but we are more focused on the companies within this space, because there are clearly trends visible on which companies are gaining market share, which companies have a better product cycle that is coming through, and we believe that will really determine the outperformance.
Okay. Ashish, the one last thing, over the course of the next 6 months, until picture becomes clear, because I think it's becoming difficult to take maybe year or 2 year calls, but over the course of the next 6 months or 9 months, as far as visibility allows you, would you prefer, within the subset that you're investing in, would you prefer outward global facing businesses, or would you prefer India inward looking businesses, considering that some of the Indian domestic oriented businesses, maybe the valuations could be higher, defense / railways / others, and maybe some other pockets too. So where is it that your preference lies and why?
No, I think that part of thought process is very clear, that it will be inward-looking businesses. Okay. I think the best barometer to look at this is oil prices, right? With whatever we are seeing happening in terms of geopolitical events, and that has not really improved over the last few months. You still see the fact that oil prices continue to come down, and that's really reflecting what is happening to global demand. So I think with the challenges China is facing, and the economic growth outlook is not improving, even as there is expectation that US rate cuts will come in and will help avoid a recession in the US. The outlook for global growth is really not great. So I think our preference is that there is much greater visibility on domestic growth stories that we can have, and the risk to earnings here will certainly be lower.
Got it. Okay. Lovely talking to you, Ashish Gupta. Thank you so much for taking the time out and being with us.
Thank you. My pleasure.
That's the view from Axis AMC. And with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.